And it's all about the Benjamins with our next guest, or rather, how you're saving them for the future. We're talking 401ks versus IRAs. And to give us guidance, Glen Wright from Worth Financial Advisory Group is here. Good morning, Glen. Thank you very much for joining us. So, I mean, let's just get right to the point. You know, what is the difference between a 401k and an IRA?
Okay. Well, a 401k is similar to a 403b or 457. They are employer-sponsored plans. An IRA is open for literally everybody, and it's an individual retirement account.
Now, with these, the amount that you can put in them is limited, but you can elect to have both, right?
Right, that's true. There are phase-outs to have both. One difference with the 401k is you're actually able to put up to $18,000 per year that goes in pre-tax. And if you're over the age of 50, you can actually put in an additional $6,000 for 2015. For the IRA, however, that number is $5,500 on an annual basis. And if you're over the age of 50, you can add $1,000. That number was not indexed at all over the last 3 years for the IRA.
So when it comes to the IRA, why would someone want to go with a traditional IRA versus a Roth IRA?
Excellent question. If you're looking to get a pre-tax deduction, then that's when the 401k or the IRA makes sense. So for a IRA that's traditional, then the money goes in pre-tax, it grows tax deferred, and then you pay the tax on the way out. The Roth, however, works a little differently. You pay after-tax dollars. It still grows tax deferred, but it comes out tax-free as long as you've had it for 5 years and over 59 and a half.
So when would you want to use one versus the other?
It really depends. And this is such a broad topic. There are many different types. It depends on where you are and how much you're trying to save. So for instance, let's say that you're actually self-employed. You may actually want to use what's called a SEP IRA, Simplified Employee Pension IRA.
Okay.
And where you can actually put in more money, up to $53,000 this year. If you work for yourself, let's say that you may make $100,000 of income, then there's something that's called the solo 401k, where you can put up to 20% of your income, but also have an elective deferral of an additional $17,500. So it's all about how much you actually want to save and defer.
So let's say you actually want to try to pass this on to, you know, your kids, your grandkids. Which one is going to be better when it comes to, you know, tax estate?
That's an excellent question. One thing that I typically find that people don't focus on is the beneficiary. So if you want to pass that down, the Roth is a powerful tool because that money grows tax deferred, it comes out income tax free, even to your beneficiaries.
Okay. Hey, Glen, thank you very much for waking up with us this morning. I appreciate it.
No problem. My pleasure.
Thank you very much.